case studies related to module C. So kindly please confirm the audio video quality so that we could proceed. Kindly please confirm the audio video quality so that we could proceed. And further, if you are new to our channel and have been watching our video for the first time, kindly go through the full video, and if you liked our video, then please do subscribe to the channel and press the bell notification icon so that you get updated whenever we upload the new video. The full course videos is available at our website iibf.info. Link I have already posted over there. And further, this is related to 45th class of the BFM. And if you want to get all the previous lectures, you can enroll into the courses at iibf.info. Start preparation, and further it is related. I'm going to tell you that you will be getting the full course videos. You will be getting the chapter wise previous questions, mock test, and further the ePDF notes will also be covered in our Android application. So do enroll right now, and if you want to join us on our WhatsApp group, you have to WhatsApp us writing CAIIB and WhatsApp it to the number 83609442207. So you are to WhatsApp us writing CAIIB and mention your name along with it, and you need to WhatsApp it to the number 83609442207. We will be adding you to the appropriate group. So the audio video quality over here seems to be working very fine. So let us start the session now. Okay. So first case study, it is related to asset liability management. First case study over here, it is related to asset liability management. It says Bank ABC has following assets and liabilities in its balance sheet as on 31st March 2021. So the different assets and liabilities are given over here, like capital, reserves, current account deposits, savings bank account deposits, term deposits, borrowings, and all the other assets and liabilities are given. And further, it is given that total assets is equal to total liabilities and is equal to 4 lakh crore. And it is equal to 4 lakh crore. And further, it is said over there that the term loans have fixed rate of interest. It is mentioned over there that the term loans are having the fixed rate of interest. So we need to tell in the very first question, we need to answer that what is the amount of interest rate sensitive assets. So we need to calculate over here what is the amount of interest rate sensitive assets in this particular case. So first step that we'll be doing, that will be bifurcating these between the segregating the data between the assets and the liabilities. So capital, kindly please do let me know at the earliest. So if we form a table over here related to the assets and liabilities, what would be related to that? How we can basically solve the question over here? So let me first of all draw a table over here where we will be calculating we will be having the liabilities. So over here we are having the liabilities on the one side, and further we are having assets on the other side. Okay, so first of all, first component, jaldi se jaldi you have to answer at the earliest. Capital belongs to what component? Capital is liability or assets? It is liability. It is a liability, and it is given to be 4,000 crores over here. And further, the reserves is also part of liability. And if we look at the current account deposits part, current account deposit, that is also what? That is also a liability. The current account deposits are also a liability. So whatsoever deposits you are having in the bank on your balance sheet, it will be on liability side. It will be your liability because you have an obligation so as to repay the deposits to the public itself. So it's your liability. So whether it is the current account deposits or it's a saving fund account deposits, both are liabilities. So we will be writing it over here. Current account deposits and saving fund account deposits, both are liabilities. And further, if you are having the term deposits, we are having the term deposits, that is also a liability, that is related to term deposit. Then balances with the other banks. So whatsoever balances that you are maintaining with the other banks, that basically that's a liability or asset. With regard of this particular part over here, that is balances with other banks, it is related to assets or liability. Kindly please do confirm at the earliest. Kindly please do confirm at the earliest. So we are having 1,20,000 over here and 1,20,000 crore over here in saving fund deposits. And in case of a term deposits, we are having it is equal to 1,20,000 again. Okay, so it basically belongs to what component over here? Balances with other banks is related to an asset. It is related to an asset. So when you are maintaining the balances with the other banks, what does it mean? That they have the obligation. So if I'm maintaining a balance with the bank ABC over here, in that particular case, I'll be saying they are having an obligation so as to pay back me those deposits. So it is my asset. it is my asset. So very right side, Priyanka Tejawat has answered at the earliest that these belong to the asset. So we will just writing it over here, bank balances. And the other component that it is related to investments in securities or the cash balances. Cash balances are basically what? Cash balances are also your asset. Cash is also your asset. And other than that, investments, if you are having many investments, those are also your assets. Then further, bills payable. Bills payable basically are those bills over here which have been discounted already, so those will be basically related to your, those will be your assets over here. And further, it is related to the cash credit component, that is the CC part of it, that is also asset. And further, the term deposits, and then it is a fixed assets. Okay, so all are the, so all are what? All are the assets over here. So let me write the components related to them, against them. So bank deposits are basically, we are having 60,000 crores. So it is a 60,000 crore amount. In cash, we are having 27,600. Investments are amounting rupees 60,000 again. Investment in securities is 60,000 again. Bills payable is 80,000 crores. And further, CC component is related to 80,000 again. And then the term deposit, it is 80,000 again. And further, fixed assets, it is 12,400. Okay, so we are now to take a total of both these sides. So 4,000 plus 24,000, that will be equal to 28,000. And further we need to calculate the, we need to find the total. We need to calculate the total over here. Okay, so we let me check if we have written write the right figures over here or not. So 4,000 and further 24,000 and further 24,000, then it is 1,20,000, 1,20,000, 1,20,000. And then it is a case related to what? It is a bank borrowing from Reserve Bank of India. We basically left that particular part, so we will be writing it over here. So it is a balances with the Reserve Bank of India. So whatsoever the balances you have maintained over there, so whatsoever the borrowings, not is balances, it is related to borrowings. Okay, so borrowings over here, it is basically related to what? It is related to your liability part. So whatsoever amount you have borrowed, that is given over here to be 12,000 crore. So if we take a total of these, so it will be 4,000 plus 24,000 is equal to 28,000. And further 12,000 from Reserve Bank of India, it is 40,000, and 3,60,000, so it is 4 lakh crore. So it is 4 lakh crore given in the question itself. We just cross-checked it. Okay, then further it is related to bank deposits. You are having bank balances with the other banks, and that is 60,000 plus so we'll take a total over here. So 60,000 plus 27600 plus investments that you are having 60,000, and further for the bills payable 80,000, and then it is 80,000 again, that is 1,60,000. And then it is a last one, that is a fixed assets, that is 12,400. That makes it 4 lakh crores. Now the question is asked from the number of candidates related that why bills payable are, how these are the assets. So these are those bills which have been discounted. That is why we have taken it as a asset over here. Okay, so these are basically related to those bills which have been discounted by the bank. Okay, so these will be taken on the asset side. Otherwise, if we look at the bills payable, it's a liability na. But in the books of the bank, if basically it's not a bill that is drawn on the bank, it relates to the bills those have been discounted by the bank. Okay, so these are basically the assets and liabilities. Now what was the first question? That was related to what is the amount of the risk sensitive assets. So risk sensitive assets, that is RSA. These are those assets, if there is interest rate fluctuation in the market, if there is interest rate volatility, then these assets will be get affected. So first of all, we have to look at the what side? We have to look at the assets sides over here. Okay, because we need to tell what is the amount of interest rate sensitive assets over here. So just look at the factor that bank deposits, basically the bank must be paying you interest rate, and further if there is change, that will be affected by the interest rate. So this is risk sensitive asset. Okay, and further, is cash a risk sensitive asset? Kindly please let me know. Kindly please do answer at the earliest. Is cash a risk sensitive asset? Is it affected by the change of interest rate? Yes or no? Kindly please do answer at the earliest. Is cash a risk sensitive asset? Yes or no? Third component, it is related to investment. So whatsoever investments you are having, it may be related to the capital market, it may be related to the securities market. Okay, so in that particular case, it is get affected by the interest rate volatility. So yes, it is a risk sensitive assets. And other cases, if it is bills payable, if you have discounted the bill, in that case, it's a particular part that you have lent to someone. Okay, so in that case also, it is affected by the interest rate change. And definitely CC part is also what, that is a cash credit that you have basically advanced or extended to the parties. In that case, if there is interest rate change, that will also be affected. That is also risk sensitive asset. So mostly all of them answer that cash is non-risk sensitive asset. Yes, definitely it's not risk sensitive, because it's a cash in hand. It relates to what? It relates to cash in hand. It will remain the same whatsoever the interest rate is there in the market itself. Okay, so term deposit that is given to be 80,000 part. Term deposit that is given to be 80,000 part. Is it over here? Is it basically relatedly it is having the what? It is clearly mentioned in the question itself that the term loans have fixed rate of interest. That the term loans are having the fixed rate of interest. So if your term loans are having the fixed rate of interest, will there be any impact related to the interest rate change in the market? There will be no impact. There will be no impact. So it will not be covered. And also, if we look at the fixed assets, if also we looked at the fixed assets over here, the interest rate does not impact the fixed assets. Okay, so the only assets which are risk sensitive assets will be the bank deposits, that is the 60,000 component. That is a 60,000 component plus the investments, that is again 60,000 component. Then it is a bills payable, that is a 80,000 component, and again the CC limit, that is a 80,000 component. So it is 1,60,000. That is 80 plus 80 is 160 plus 60 is equal to 220, and 60 that is equal to 280. So it will be equal to 2,80,000 crores. So 2,80,000 crore of the assets are the risk sensitive assets. So I'm writing it over here. So risk sensitive assets are 2,80,000 crores. So we will just writing it 280k over here. Is that clear? Okay, so that is related to the first question. I hope that this particular part is clear. That the total amount of the assets which is affected by the interest rate is 2,80,000 crore. Okay, next question goes like the question number 2 over here. It is related with the what is the amount of the interest rate sensitive liabilities. So over here we need to find out the total number of assets which total number of liabilities which are basically affected by the rate of interest. Okay, so we are basically to calculate RSL. We are to calculate RSL, that is risk sensitive liabilities. Okay, so risk sensitive liabilities would be those liabilities if the interest rate volatility or interest rate change is there, the value of these liabilities will be altered. Okay, now the risk sensitive liabilities is capital risk sensitive, is a risk sensitive liability. Is capital a risk sensitive liability? Kindly please do answer at the earliest. In case of current account also, we paid no interest is paid. In case of current account deposits, no interest is paid. So it is also not what? It is also not risk sensitive asset. In the case of saving fund, the interest rate is paid. It is what? It is risk sensitive liability, not asset. It is risk sensitive liability. And the term deposits, in the case of the term deposits, these are also what? Are the term deposits risk sensitive? Yes or no? Are the term deposits, I'm writing 2 over here, you need to answer writing 2, because otherwise it will be I'll be getting confused related to that you have answered related to capital or what else. Okay, so first of all, let me tell you related to capital and the reserves. Capital and reserves are not risk sensitive. These are not risk sensitive. Okay, so these are also not what? These are also not risk sensitive. Now you need to answer me writing number 2 over here, that is term deposit risk sensitive? Yes or no? Is term deposit risk sensitive? Yes or no? And also Reserve Bank of India, the balances, the borrowings from the Reserve Bank of India, is it risk sensitive? Yes, it is risk sensitive. Related to the term deposit, yes, it is risk sensitive. It is a risk sensitive over here. If the repricing is there, in that case it is risk sensitive. Is that clear? Okay, so the term deposit would be risk sensitive over here. So we are having the different components which are risk sensitive, that is saving fund deposit, term deposit, and the borrowings from the Reserve Bank of India. Reserve Bank of India. So these are risk sensitive liabilities over here in this particular case. Is that clear? Is that clear over here? So it is 1,20,000, 1,20,000 and 12,000, that it is 2,52,000 crores. So what is the risk sensitive liabilities amount? What is the RSL amount? It is 2,52,000 crores. Is that clear? So that would be related to the question number 2. Now we need to answer the question number 3. Let us have a look at it, what it is. So question number 3 over here, it says, in this case, how much and what type of gap is there in interest rate sensitive assets and interest sensitive liabilities? In interest sensitive assets and interest sensitive liabilities, what type and how much gap is there? So the gap is, we are quite clear with, we are having gap of amount rupees 28,000. 28,000 crores is the gap between the RSA and RSL, and RSA is exceeding RSL. This is exceeding RSL over here. So RSA is greater than RSL. RSA is a 2,80,000 and RSL is a 2,52,000. The gap is 28,000 crores. The gap is amounting rupees to 28,000 crores. And what type of gap this is? Is this a positive gap or a negative gap? Is this a positive gap or a negative gap? We need to answer that what is the amount of the gap, and further we need to answer that what type of gap it is. It is a positive gap or a negative gap. So the right answer over here has been given by the Bharani Vasuki. Bharani Vasuki over here has given the right answer, first of all, that it's a positive gap. So whensoever your risk sensitive assets do exceed the risk sensitive liabilities, in that case it's a positive gap. If the risk sensitive liabilities means if the payments are going to be more than that of the receipts, in that case it's a negative gap. But where the receipts, because our assets are, it is basically related to those amount that you will be receiving, over the time horizon. Okay, so in that case it's a positive gap over here. So as per the question and as per the data given over here, it's a positive gap of 28,000 crores. Okay, that is related to question number 3 over here. So it's a positive gap over here in this particular case. So the gap is positive and further it is amounting 28,000 crores. Is that clear? Now let's have a look at the question number 4 over here, which it says, what is the amount of tier 1 capital of the bank? What is the tier 1 capital of the bank? Now in this particular case, we are not provided with much of the data, but we need to calculate and we need to tell what is the tier 1 capital of the bank over here. We have already gone through the different components of the tier 1 and the risk management component module B, and further we know what are the different components over there. And as per the data which is provided to us in the question, we need to answer related to what? We need to answer related to the tier 1 capital. We need to answer related to tier 1 capital. So tier 1 is basically related to what? It is a going concern capital. And it is said to be core capital. So we need to answer over here, what is the amount of the tier 1 capital in this particular case? So if you remember, the different components of the tier 1 capital were comprising of the paid up capital and reserves. They were comprising of paid up capital and reserves. So the capital is worth 4,000 crore over here and reserves are amounting 24,000 crores. So the tier 1 capital over here in this particular case, it is 28,000 crores. So it will be 28,000 crores. So it is a sum total of capital and reserves in this particular case. So it will be 28,000 crores as per the question data given. Is that clear? Okay, so our answer will be 28,000 crores. So again, Bharani Vasuki has given the right concept related to it. So I'll be considering the right answer from Bharani Vasuki first of all. Okay, that is related to the case study, and further it is related to case study on calculation of CRR. Case study on calculation of CRR, that is a cash reserve ratio. So we have already gone through cash reserve ratio. That cash reserve ratio is defined as per Reserve Bank of India Act section 42 subsection 1, and further there is no upper limit, there is no lower limit, no interest is paid on CRR, and further CRR is to be maintained as a percentage of net demand and time liabilities, and in the form of the cash it is to be maintained with the Reserve Bank of India. And main objective related to maintenance of the CRR is related to the solvency of the bank. So as to maintain the solvency of the bank, the CRR is to be maintained. Okay, and for the CRR, we need to solve the question over here. We need to solve the question over here. So ABC Bank has following assets and liabilities in its balance sheet as on March 31, 2021. So the assets and liabilities are given over here. So we are provided with the assets and liabilities. So the capital, reserves and the other assets and liabilities are provided over here, and it is given over here that the total of the liabilities is equal to what? It is equal to the 2,53,320 crore. It is 2,53,320 crore, and based upon this information we need to solve the questions. First question over here, it says what is the amount of liabilities that will not be included in the net demand and time liabilities for the purposes of the CRR calculation. So as we need to calculate the CRR as a percentage of the net demand and time liabilities, in first question we need to calculate that what liabilities, what amount of liabilities will not be included over here. First of all, we need to segregate what? We need to segregate the total liabilities, but that is already given over here. That is a total liability over here. It is given to be 2,53,320 crore. That is the amount of total liabilities over here. And what amount of the liabilities is not basically covered in the calculation of the CRR? In the calculation of the CRR, what amount is not covered? What different components are not covered over there whenever we calculate the CRR? Whenever we do calculate the CRR. So kindly please do let me know, first of all, related to components. We have already gone through that particular part when we were basically covering the CRR and SLR topic related to the funding requirements. In that particular case, we covered this particular part also. So kindly please let me know the different components which will not be the part of the NDTL calculation, which will not be under the calculation of the NDTL, that is a net demand and time liabilities. So the different components are given to be related to the capital, reserves, demand deposits, saving bank deposits, term deposit with the public, term deposit with the bank, and further the borrowings from the financial institutions, the NABARD refinance, bills payable, interest accrued, subordinated debt, and the suspense account. Which amount is not to be included in the net demand time liabilities whensoever we are to calculate the for the CRR purposes. So let me tell you that the paid up capital is not part of what? It is not the part of the CRR calculation. It is not the part of the NDTL, that is the liabilities, for the calculation purposes. So capital amount is to be subtracted. So that is basically related to, I'm just writing it over here, capital amount is to be subtracted, and further it is related to what? It is related to if there is any positive, if there is any balances of the profit and loss account, that is to be basically not to be calculated. And further, whatsoever the balances are maintained with the banks, term deposits are maintained with the banks, those will also not be covered. So in this particular case, the term deposit with the banks, it's given to be term deposits with the bank, that is also not to be covered. And further, it is related to NABARD refinance. So there is any refinance facility undertaken, so that is also not to be taken over here. So NABARD refinance is also to be subtracted. So these will not be the components that will be covered for the calculation of the NDTL. Is that clear? So we need to subtract all these components related to the CRR calculation over here. So let me tell you the components again. That is related to that you will not be basically covering the paid up capital. We will not be covering the bank borrowings. We will not be covering related to the we will not be covering any of the NABARD refinance or ECGC funds, or if you have any liability, if you are having any of the claims against the DICGC, those are also not to be covered. Okay, so the paid up capital and reserves. So reserves part is also there. Okay, reserve part is also there. If there is any bill you have rediscounted, from any bank, by any bank with the eligible financial institution or with the Reserve Bank of India, those will also not be the part of it. also not be the part of it, other than if there is any amount which is received from ECGC. If the bank has received any amount from the ECGC, or if the bank is having any of the amount received by the from the DICGC, that is also not to be covered. If there is any subsidy released by the NABARD, that will also not be covered. That will also not to be covered. Other than that, if there is any credit balance in the profit and loss account, and further any of the refinance facilities taken, that is also not to be taken. That is also not to be taken. Is that clear? Okay, so capital and reserves are amounting rupees 4800 crores. So it is 4800 crore, and for the reserves are 7600 crore. The term deposit with the banks is 6300 crore, and further the NABARD refinance is basically amounting 650 crore. So the total amount that we'll be calculating over here, it will be 4800 crores plus 7600 crores plus 6300 crores plus 650 crores. Okay, so it is 19350. So it is 19350, that is a component that will not be covered over there. Okay, for the calculation of the net demand and the time liabilities. Is that clear? Okay, now let's move to the second question over here. Which says, what is the amount of the net demand time liabilities on which CRR is to be determined? What is the amount of the net demand time liabilities on which the CRR is to be maintained? Kindly please do answer at the earliest. So what is the amount of the net demand time liabilities on which we will be calculating the CRR? CRR is to be maintained on fortnightly basis, and further on the other days it is to be maintained on average 90%. Okay, if you are having term deposit, so there is a question related to over here, that term deposit with the other banks, not with other banks, it is related to term deposit of the banks. If the other banks are having the term deposits with you, in that case it's a liability for us. Now there is a difference. If we are having term deposit with other banks, it's a asset to us. But if the other banks are having a term deposit with us, in that case it's a liability to us. Okay, so we will be simply subtracting 19350 from total calculation of 253320. So we will be simply subtracting 19350 from the total, that is 253320. That is basically 233970. That is basically the CRR calculation for the term deposit NDTL. It will be on 233970. Okay, where we are going to calculate the calculation for the CRR. Third question, it says, at 3% of the term net demand term liabilities, in that case prescribed rate of CRR by the Reserve Bank of India. Let us assume that over here, as per the question, that 3% of the net demand time liabilities is prescribed as a CRR. What will be the average balance to be maintained by the bank with Reserve Bank of India? What is the average balance that is to be maintained by the bank with the Reserve Bank of India? So we will be just calculating 3% of this. So it will be amounting to simply 233970 multiplied by 3%. So it comes out to be 7019 crore. 7019.1 crore. This is the average balance that is to be maintained as a CRR with the Reserve Bank of India. Okay, so that would be the balance that we need to maintain. We simply multiplied the CRR prescribed percentage with the net demand time liabilities which are eligible for the CRR calculation. So the part comes out to be 701.91 crores. Is that clear? That is related to question number 3. And question number 4 over here, it says, what is the minimum balance in the CRR account with the Reserve Bank of India in above situation, which should be available if the minimum requirement is 90% of the average fortnightly balance? If we are to maintain 90% of the average fortnightly balance, in that case what amount must be there that is to be maintained with the Reserve Bank of India on daily average basis? So 90% of the daily that daily average basis amount is to be maintained. So we will be simply calculating 90% of this. So it is 6317.19. So related to question number 4, it is a 6317.19 crore is the average balance that is to be maintained on daily basis by the bank in the CRR account. So it is a 6317.19. Okay, so we simply just calculated first of all the CRR requirement, and then we calculated the 90% of the 701.19. Okay, that would be the answer related to the question number 4 over here. Is that clear? Kindly please do answer at the earliest if you're clear with it or not. Okay, and the last question for this case study, it says, while calculating the net demand and time liabilities for CRR purpose, which of the following liability is to be excluded? Which of the following liability is to be excluded? Kindly please do answer at the earliest. So while calculating the net demand and time liabilities for CRR purpose, which of the following liability is to be excluded? So what would be the answer related to it? What would be the answer related to this question? Question number 5 over here. What would be the answer? So when we do calculate the net demand and time liabilities for CRR purposes, which of the following liabilities are to be excluded, are not to be covered when we are calculating the net demand time liabilities? So it will be option D, that is all of the above. That is all of the above. Okay, so capital and reserves, and further if you are having any refinance from the NABARD, SIDBI, NHB, if you are having any of the rediscountings, that is to be excluded. Other than that, if it is related to interbank deposits with the banks, if it is related to interbank deposits with original maturities of 15 days or above, that is also to be excluded. So option D over here will be the right answer. So first of all, Lucky Bakshi has given the right answer, that is option D over here will be the right answer. So question number 5, option D is the right answer. Next case study is related to the asset liability management. So bank wise maturity profile of selected deposit category of the banks is in the percentage terms of a selected maturity buckets as on 31st March 2021 is given. So percentage is given over here in the terms of a percentage related to the selected deposit categories for the different categories of the banks is given. Maturity profile is given over here, and further we need to answer as per the data given over here. So the liabilities are given over here related to up to 1 year, up to over 1 year to 3 years, above 3 years to 5 years, over 5 years, and the total percentage is 100 in each and every case. And further the different data is given over here related to the different maturity profiles and related to the different categories of the banks. Okay, so first question over here, it says there is a decline in a rate of interest of 2% for a period up to 1 year. There is a decline in the rate of interest for up to in the rate of interest of 2% for a period up to 1 year. The bank group which will gain the most is which bank? PSUs, old generation private banks, new generation private banks, or the foreign banks? Kindly please do answer at the earliest. Which bank will be having the more gain or the most gain in the case where the rate of interest are declined by 2%? Where the rate of interests are declined by 2% over a time horizon of up to 1 year, which bank will be benefited the most? Which bank will be benefited the most? Kindly please do answer at the earliest. What would be the answer? It will be PSU banks, or old generation private banks, new generation private banks, or the foreign banks. So kindly please do answer at the earliest. So let me tell you, first of all, related to, we are talking about what? We are talking about the liabilities. So we are having the liabilities. Over here up to 1 year maturity profile. And if you look at the table over here related to the different banks over here, which bank is having the most liabilities lying under this time horizon? The old generation private banks. Old generation private banks are having the highest liabilities. All generation private banks are having the highest liabilities. So if there is a decline in rate of interest, we are considering what? Let us take the case that previously we were paying 8% of the interest to our depositors, and now we have to pay 6% of the deposit. We have to pay 6% of the interest because it is declined by 2%. So what bank will be benefited the most? Definitely the old generation private banks will be benefited the most because they are having the highest deposits in that particular category. Okay, so that is related to question number 1, that is the old generation private banks. So first of all, Shiv Vishnu has given the right answer over here. Next question over here, it says there is a decline in rate of interest of 2% for a period up to 1 year. The bank group which will gain the least is, what would be the answer over here? What would be the answer over here? Question number 2, that is there is a decline. The same question, as the same condition stipulates that there is decline in rate of interest of 2% of the for a period up to 1 year, but the question, it says the bank group which will gain the least is, what bank will having the least gain? The bank which is having the least liabilities over that time horizon. So PSUs will be having the least gain in this case. So the question 2 answer is a PSU, that is public sector undertakings. That is a PSU banks will be basically gaining the least. Okay, so related to question number 2, the first answer has been given by Swaroop Biswal, that is a PSUs. Okay, now let us have a look at the question number 3 over here. It says there is increase in a rate of interest of 1%. There is increase in a rate of interest of 1% for deposits with a period of above 1 year up to 5 years. So the rate of interest is now increased for deposits with a period of above 1 year up to 5 years. 1 year up to 5 year. Okay, the bank group which will be most affected adversely, the bank group which will be most affected adversely will be what bank category? We need to answer related to the question number 3 over here, where the situation is there is increase of 1% for the category of the deposits over 1 year up to 5 years. Over 1 year up to 5 years. In that case, what bank will be affected adversely? What bank will be affected adversely in this particular case? So again the answer will be PSU. So question number 3 answer has been given by the Shiv Vishnu again, that PSU, that is public sector undertaking banks, will be affected adversely. Why it is so? First of all, look at the factor. We are not considering only one window. We are going to consider 2 time horizon, that is above 1 year up to 5 years. Above 1 year up to 5 years. So it includes this one and also this one. So it includes the both, that is over 1 year and further over 3 years up to 5 years. Okay, so we were to consider the 1 year up to 5 years. So it will be basically, we will be considering both of these categories. So sum total of these to be taken. Instead of taking only one category over here, one category of the time horizon over here. So we will be considering both of these as total. So the total in the first case, it comes out to be 59. In the second case, it comes out to be 48. In third case, it is 53. And in fourth one, it is 57. So which one is having the highest liabilities? PSUs are having the highest liabilities in this particular case over this time horizon, above 1 year up to 5 years. And in that case, if the interest rate is increased, which will be adversely affected? Definitely the PSUs will be adversely affected. So the answer over here will be PSU. That is related to question number 4. Next question, it says there is increase in rate of interest of 1% of the deposit with a period of above 1 year up to 5 years. The bank group which will be least affected. Now, which bank will be least affected? Which is having the lowest liabilities over that time horizon. So again, we have to consider the 2 windows. Over here. Okay, so now which bank is having the least deposits? Which bank is having the least liabilities in this particular case? Old generation private banks are having the least liabilities over this time horizon, that is a 48. So those will be least affected by the increase in rate of interest of 1% in this time horizon. Okay, so the question number 4 answer will be old generation private banks. It will be related to the old generation private banks. So the first of all answer has been given by Shiv Vishnu again. Okay, so question number 4, the answer is old generation private banks. Next question, it says the bank group which is more relying on long term deposits above 3 years. The bank which is more relying on long term deposits above 3 years. Which bank it is which is relying on long term deposits, which is relying on long term deposits the most? So which banks are relying on long term deposits? So is it the PSU or old generation private banks, new generation private banks, or the foreign banks? So which category of banks are relying most on the long term deposits above 3 years? So we will be considering two categories or two time horizons over here. Again, over 3 years, up to 5 years, and over 5 years. So in case of a PSUs, we are having the most liabilities equal to 30. Other than that, we are having 13, 7, and 12 only. So PSUs are relying more on the long-term deposits. These are relying on the more on the long-term deposits. Okay. So that is the case related to what? That is the case related to the asset liability management case study number 4. The next case study is again related to the asset liability management. So let us have a look at it. So in this particular case, we are provided with the maturity based profile on the selected investment of the categories. On the selected investment categories of the different categories of the banks in the percentage terms. It is given over here. So we provided with the case that PSUs have invested into different investments, old generation banks have invested, and further the new generation private banks and the foreign banks have invested the monies into the different categories, whether it is a capital market or it is a securities market or it is a money market. Those have invested into the different categories, and further this is given over the different time horizons. Okay, likewise PSUs have invested 27% of their investments in up to 1 year time horizon. Is that clear? So that is the data given to us, and further we need to answer accordingly. Okay, so the first question over here, it says there is a decrease in average yield of 0.75% for up to 1 year maturity, and the bank group which will lose the most is. Okay, so there is a decrease in average yield of 0.75%. There is decrease in average yield of 0.75% for up to 1 year. So for up to 1 year, we need to consider the data related to up to 1 year only. So we will be looking at just this time horizon, that is up to 1 year. Okay, so we will be looking at that which bank is having the highest investments. The old generation private banks are having the highest investments. So if there is decrease in yield, which bank will be affected the most? Definitely the old generation private banks will be affected the most. The old generation private banks would be affected the most. So answer over here is old generation private banks. So the first of all, the right answer has been given by, the correct answer has been posted by Paranshu Mayank. It is posted by Paranshu Mayank, that is old generation private banks will lose the most. They will lose the most because they were having the highest investments over that time horizon. So if the yield is decreased by 0.75%, they will be losing the most of it. Okay, and the second question, let us have a look at the second question now. So it is related to there is decrease in average yield of 0.60% for over 5 years maturity. For over 5 years maturity, there is a decrease in average yield of 0.60%. Which bank will lose the least? Which bank will be losing the least amount of monies which they have invested over 5 years a time horizon? Okay, so what would be the answer related to it? I hope that you are now clear with the concepts related to the maturity buckets. You're basically clear with the concepts related to the risk sensitive assets and risk sensitive liabilities. So which bank will be having the least loss? Okay, so over the time, over the 5 year horizon, which bank is having the least investments? The new generation private banks are having the least investments over the time horizon over above and 5 years. Over and above 5 years, the new generation private banks are having the least investments. So if there is a decrease in average yield, they will be basically suffering with the least of the losses. Okay, so answer over here is a new generation private sector banks. So first of all, the right answer has been posted by Rahul Singh Rajput. The first correct answer has been posted by the Rahul Singh Rajput. So question number 2 over here, the answer is new generation private banks. Related to question number 3, we are having there is increase in average yield of 1.2% for over 5 years maturity. For over 5 years maturity, if there is increase in average yield, if there is increase in average yield, which bank will be gaining the most? Which bank will be gaining the most if there is increase in yield? Definitely the bank which is maintaining the highest investments in that particular time horizon, that will be having the most benefits, that will be most benefited out of this scenario where there is increase in yield, where there is increase in yield. So the right answer over here, it is related to PSU, because again we have to look at the over 5 years bucket over here. That is related to what? That is related to the PSUs over here. So PSUs have invested over here the most, that is 14%, and further those would be benefited the most. So question number 3, the answer is PSUs. Answer is PSUs. At least once the conditions are in favor of PSUs, otherwise they have lost the most of money in the case of case study. Okay, question number 4 over here, it says there is increase in average yield of 1.5% for over 5 years maturity. There is increase in average yield of 1.5% over 5 years maturity. The bank group which will gain the least. The bank group which will gain the least. Again, it is related to over the 5 years maturity. So it will be related to what? The banks who have basically invested the least into the over 5 year maturity bucket, that will be basically having the least gain. So it is related to new generation private banks. It is related to new generation private banks. So again, Rahul Singh Rajput has given the correct answer at the earliest, that is a new generation private bank. So that would be the answer. Question number 5 over here, it says assume that most of the investments comprise investments in the government bonds and have negligible investments in shares and debentures. So if we assume the fact that most of the investments comprise investment in the government bonds and have negligible investments in shares and debentures, if there is increase in market rate of interest of 1%, if the market rate of interest is decreased by 1%, the highest decline in the value of the investments will be faced by which of the group of the banks in over 5 year category? In over 5 year category, which bank will be facing the highest decline in the value of the investments? That if there is a decrease in the market interest by 1%, and most of the investments are there in the government securities and government bonds over there, in that case, if there is negligible investment in capital market that is related to shares and debentures, which bank will be most affected in this particular case? So what would be the answer in this particular case? Now, over 5 year window, we have already seen the fact that the PSUs have invested most of the percentage of the investments, and the new generation banks have invested least percentage of their investments. Now, in this particular case, which bank will be most affected? Which bank will be most affected? Definitely the PSUs bank will be more affected. PSUs bank will be more affected. So this is related, the question related to what? That the investments in government bonds, and further if the investment even in government bonds, if there is increase or decrease in the yield, that is a market rate, that will basically alter the traded value of the security. It means the traded value of the bond itself. So that will basically, in that particular case, the bank who has invested the most of the money in that particular time horizon, that will be basically facing the most of the losses. Okay, so that is PSU would be the right answer over here, question number 5. So Swaroop Viswal has given the right answer related to question number 5 over here. That is a PSUs. Okay, so that would be all related to the module C over here. I hope that you must have understood the concepts related to that. So kindly please do rate this video out of 10, and further from tomorrow onwards we will be covering the module D. So we'll be starting with module D. So if you have not gone through all of the previous videos, you can do enroll the courses visiting our website iibf.info, and do enroll right now. You'll be getting flat 75% off, and over and above you'll be getting extra 12% off applying the coupon code year end. The total discount which will be available to you will be 78%. So this is the best time so as to enroll into the courses and start preparing right now. And further you'll be getting the full course videos, you'll be getting the case study videos, you'll be getting the chapter wise previous questions, mock test, and further you'll be getting the ePDF notes through our Android application too. So start preparing right now. If you want to join us on our WhatsApp group, you have to WhatsApp us writing CAIB mention your name along with and WhatsApp it to the number 83609 and we will be adding you to the appropriate group. Our Telegram handle is also available. Kindly please do join visiting the description over there below in the link over here, and further join the Telegram channel also. So kindly please do the needful and do not forget to like this video and share this video. So this is Ashish and signing off right now, and see you again tomorrow at the same time, 7 p.m. in the evening.